Revered men and women, I hereby call to order today's episode of ETF Battles. Hi there, everybody. I'm Ron DeLegge. And it's been said that dividends are something tangible. It's not an earnings projection. It's something solid. It's in hand. It gets deposited in your wallet. And dividends are a true return on an investment. Everything else is hope and speculation. And for that reason, it's not surprising that dividend stocks and dividend ETFs are so popular with investors. And with that in mind, today's skirmish is between the iShares Core Dividend Growth ETF, that's ticker symbol DGRO, versus the WisdomTree US Quality Dividend Growth ETF, DGRW. Both of these funds have been requested by you, the audience. We've seen both tickers pop up a number of times. And so this battle matchup is going to feature funds that are both index linked and focused on stocks with increasing or rising dividends. DGRO is the larger fund by assets. It has just over 12 billion, where DGRW has around 4.5 billion. So which ETF wins this battle? Which is the better play for dividend growth? Before we find out, just a quick reminder to be sure to watch our new episode series, Portfolio Report Card, where I analyze and grade your investments. It's a new weekly series from ETFguide TV. Do not miss it. Helping us to judge today's matchup is Todd Rosenbluth, head of ETF and mutual fund research at CFRA, and John Davi, founder and CIO at Astoria Portfolio Advisors. Gentlemen, welcome back to the program. Great to see you.
Good to be with you, Ron and John.
Hey, guys.
So the battle categories for today's showdown is going to be cost, exposure strategy, yield, and performance. And then we've got our mystery battle category where you, the judges, get to pick that one factor or multiple factors that you feel are important to this particular analysis between these two ETFs. As you can see, I've got my scorecard. It's blank, which means I'm going to fill it out as we go along here, one by one. And we're going to give our judges, each of them, 30 seconds to weigh in on each of these ETFs and these various categories. So we're going to begin with the first one. We're going to start with Todd. You've got 30 seconds. We're going to begin with cost between DGRO and DGRW. Who wins the battle?
The DGRO, you mentioned it's the larger, it trades more, I believe. The expense ratio is lower for DGRO versus DGRW. I think it's 8 basis points versus 28 basis points. You're getting iShares using their scale to competitively price this product versus others, whereas WisdomTree is charging a slight premium versus where we've seen some of the dividend growth strategies. So DGRO is the winner from a cost standpoint.
All right, that's a strong start. Thank you, Todd. What about you, John? How do you see it in terms of cost? Who wins the battle?
Full disclosure, we own DGRW, so we're going to talk favorably throughout this whole battle about the ETF. It's one of my top 10 ETFs. Every year I put a top 10 ETF list, and I've had it in that list for in the past. So it's our anchor product. I mean, yes, DGRO has a lower management fee. DGRW has a higher management fee, but in our eyes, it makes up for it. So I'll give DGRO, I'll throw them a bone in this one case, but outside of that, the battle's going to end for you, Todd. So.
Well, for me, I didn't bring this one. This is what the audience requested. You'll see. Don't prejudge my answers.
We've got judges judging judges. All right. Well, I love it. This is a good start. You guys agreed on that one. We're going to see how the rest of these categories shake down. I got a feeling that we're going to have some disagreements here, but that's okay. Let's shift to the next battle category, which is exposure strategy. So you're still up, John. How do you see it?
So DGRW is a high quality ETF. I mean, it screens for companies that have above average ROE, above average ROA, and then above average earnings. So it's going to be a lot of blue chip companies. DGRO has, it's called dividend growth. I don't actually know what it's doing, but it's got like a 20% allocation to financials. And, financials are down significantly this year. KBWB from, the March rate is down like 30-35%. I don't quite understand the 20% allocation to financials. Meanwhile, DGRW has only like 4 or 5% to financials. Technology is much higher in DGRW. It's about 25% versus only 20% for DGRO. I think that's going to be why you have dramatic outperformance for DGRW this year compared to DGRO. We'll talk about that later. But one is what we view DGRW as high quality stocks, whereas DGRO, I think there's a little bit of a value trap in there with financials at 20%. I'm not comfortable with that, so I give the edge to DGRW.
All right, very good. What about you, Todd? How do you see it in terms of exposure strategy? Do you agree with John's analysis?
So a couple of points that John made, I just want to reiterate. Both these ETFs have a healthy weighting within technology. Apple and Microsoft are top positions. If we're talking about broader dividend ETFs, that's kind of rare. Most of the dividend ETFs look backward, farther in time, and you wouldn't have these technology companies with exposure. Yeah, financials has been a drag, and financials is not a high quality area to be investing in. There's more industrials exposure, for example, within DGRW. And we like the quality tilt that's being offered, and that's more forward looking with DGRW. DGRO looks backward. There's nothing wrong with looking backward at dividends. It's just you're missing out on some of these up and coming companies. So DGRW has stronger exposure according to CFRA's research.
Wow, look at that. You guys, after two battle categories, agree with each other. So we're halfway home. We're going to see if that continues, that trend. We're going to move now to yield and performance. So Todd, how do you see it in terms of the battle winner between these two ETFs?
Yeah, so the yield on these products are roughly comparable. It's higher than you're going to get from the S&P 500 index, but because there's a growth component, it's not that much higher. The bigger difference is the pure performance. DGRW has outperformed, I think, 700 basis points within the past year versus DGRO, 200 basis points if we go back 3 years. I think John will agree with this, don't think investors should rely on past performance solely, but if you were looking at past performance, you'd be very pleased with DGRW.
All right, so DGRW is your winner?
Yes.
Okay, very good. What about you, John? How do you see it in terms of the battle winner yield and performance between these two ETFs?
So I would agree with Todd that I think DGRW wins on outperformance versus DGRO. You've had pretty dramatic outperformance on a year-to-date and one-year basis, 700 to 800 basis points. On a 3-year basis, I agree with Todd. It's outperformed a couple hundred basis points. I would focus on risk-adjusted returns and what return per unit of risk you've got from the ETF. Which when we compare DGRW versus, let's say, SPY, DGRW is our anchor versus SPY, right? We're trying to outperform SPY. We are active managers at the end of the day. So that wins in that standpoint. Yield, DGRO has higher yield. It's got 2.4% yield versus DGRW at 1.9%. You got to be careful with yield though, right? Because DGRO has this 20% of financials, which are higher yield than the market, but financials carry a lot of risk. There's a lot of interest rate sensitivity in the financial space. Obviously the sector was hit hard with COVID and credit write-downs. So you never want to buy anything just based on yield. I think you want to buy something that you believe will deliver attractive risk-adjusted returns, which I think DGRW has versus its peer, which is the large cap U.S. equity index, something like SPY, let's say. So overall, I'd still give the battle category winner to DGRW.
All right, that's some solid points too that you make about yield. Appreciate that. And keep in mind too, audience, that we're talking about dividend in the context of this battle, dividend growth. So it's not just where the dividend yield is at right now, but we're just talking about this, from this point forward, the sustainability of the dividend and the ability of those dividends to grow. So just keep that in mind. We're not just focusing on what the dividend yield is at right now for this particular battle. Of course, that is a factor, but let's shift now to the mystery battle category. This is where the judges get to pick that one factor or several factors that they feel are crucial to today's battle. John, you're still up. What is your mystery battle category and who wins it?
So I'll give valuations as the category. DGRW wins in my eyes. You've got higher gross margins, like 34% versus 23% for DGRO. You've got higher ROE. You've got 26% ROE in DGRW versus 14% in DGRO. You've got about 8% ROA compared to 2.5% for DGRO. You do pay a higher valuation multiple, about 22 versus 19, DGRW being higher. Overall though, what we've seen the last 5 years is that everyone's been buying quality stocks, and that's typically is a factor that works well when you're in the later stages of the economic cycle. One thing that we are starting to do in our firm is trimming quality a little bit to buy in other factors that are a little bit more cyclical, like mid and small cap. But, I don't think that's too expensive. 3 valuation turns for a DGRW versus DGRO. I think you're paying for quality. It's still a good, core factor to own in your portfolio. But overall, I give DGRW as a category winner for valuation.
All right, let's shift to Todd. This is the mystery battle category. Todd, what is it and who wins it?
So CFRA independently is rating DGRO and DGRW, as well as over 1,000 equity ETFs. We cover 1,800 ETFs in general. DGRW gets a higher rating. We, as we look forward, find the reward potential and the risk reduction to be better at DGRW than we do at DGRO. So because it gets a higher rating and we think it's going to outperform over the next 9 months, it wins that battle category of mystery exposure of CFRA's forward-looking rating.
So DGRW is your winner?
Yes.
Okay. Now let's shift to the final overall battle winner. This is where our judges get to give us the recap of who they think is the better ETF for today's battle. So Todd, how do you see it between these two ETFs?
The DGRW is our winner. Yes, it doesn't win in the cost category, but it stands out from an exposure standpoint with its quality focus. It stands out from its performance record over the last 3 and 1 year. It gets a higher rating as we at CFRA look forward. It's the better dividend growth ETFs. DGRW is the winner. And I think John could just say, I own DGRW, and we can end it there.
Okay. Well, let's give him his final 2 cents. Thank you for weighing in, Todd. John, how do you see it?
You remember the movie The Godfather when Hyman Roth goes to like Michael Corleone? He's like, this is the business that we've chosen. Remember that line in The Godfather?
Yes.
I mean, at the end of the day, we're providing models to our clients, and we're saying that on a risk-adjusted basis, we think we'll do better than the benchmark. And by doing that, we've got to do something different than the benchmark in order to outperform it. So DGRW, has a bunch of high-quality stocks. We're very comfortable with the methodology. We've owned it for years. Yes, it's had better performance, but that's not the only thing. Like, when you buy ETFs, you really got to understand what's under the hood and what's driving the sector composition and changes. And I just can't get past the 20% towards financials in DGRO. It just boggles my mind. So, we're comfortable with DGRW. We've owned it for years, and that's our core U.S. large cap factor exposure.
All right. Well, the judges have weighed in, and before I declare the final winner, I just going to say that there were several 30-second shot clock violations, and I had a chance to play several rounds of tic-tac-toe while you guys were, instead of enforcing the shot clock as I should, as a good referee, I was playing tic-tac-toe. So you're going to see that on the battle scorecard. Nevertheless, I was keeping track. I was paying attention, and you guys overwhelmingly voted in favor of DGRW as the better ETF in terms of dividend growth. You agreed on everything. Can you believe that? You agreed on cost. You agreed on exposure strategy, yield and performance, mystery, as well as the overall ETF battle winner. So I'm quite impressed that you guys agreed. But DGRW was a clear overall winner. It beat DGRO in all of the categories, with the exception of cost. So cost was the only area. And a couple of key takeaways from today's program, and I think you guys hit on this, is if you want to beat the indexes, you got to be different, right? You don't want to be a closet indexer. That's pretty important. Also, keep in mind that dividends are just one component of your overall investment return, right? Do not forget about capital growth, right? Because capital growth plus your dividends, that's your overall return. And then, of course, we always want to minimize expenses. The less that we pay in expenses, right, the more that we end up keeping in terms of dividend income in your own pocket instead of Wall Street's. So I want to thank Todd and John for their insightful and timely analysis. As always, you guys did a great job. Before signing off, which ETF battles would you like to see in our next episode? Hit me up on our YouTube comment section. You can also find us on Twitter at ETFguide. Be sure to hashtag ETF Battles and give us your ticker symbols. Thanks for watching. I'm Ron DeLegge. And until next time, watch the battle before you invest right here on ETF Guide TV.